investment funds traded on stock exchanges. First, we need to understand what are ETF. ETF is nothing but exchange traded funds. These are investment funds traded on stock exchanges similar to the stocks. They hold a diversified portfolio of assets like stocks, bonds, or commodities. They aim to track the performance of specific index. Its trading value is based on the net asset value of the underlying stocks. ETF share prices fluctuates all day as it is bought and sold. So in this case, it is totally different from the mutual funds that are traded only once in a day after the market closes down. So exchange traded fund can own hundreds of and thousands of stocks across the various industries, or it can even hold isolated stock. For example, bond ETF. So this includes government bonds, corporate bonds, etc. Now we will see what are the advantages of this exchange traded funds. First is the diversification. So these ETF provide exposure to a broad range of assets. They will also reduce the risk associated with the individual securities. Next is the liquidity. ETFs can be bought and sold throughout the trading day at market prices. The next advantage is that they have a lower expense ratio compared to the mutual funds. The holdings are usually disclosed daily. The transparency of the ETF is another advantage. The ETF provide a variety of investment strategies including sectors, commodities and bonds. This flexibility is also another important advantage. On the whole, the flexibility, transparency, lower cost, liquidity and diversification are the important advantages of these ETF. Nextly, we will also discuss about the India's capital gain taxation. This is a tax on the profit that we get from sale of a non-inventory asset such as stocks, bonds or the real estate. So, when the selling price exceeds the purchase price, then the capital tax is levied. So, in India, they are of two types based on the duration of holding the asset. One is the short-term capital gains tax and another long-term capital gains tax. The short-term capital gains tax. In the short-term capital gains tax, the gains from the sale of an asset is held only for a short duration. So let's say it is less than 36 months for real estate and less than 12 months for the securities. The tax rate for this is almost 15% along with the applicable surcharge and cess. The surcharge and cess is also charged along with the tax. Let's take an example to explain this. If you buy a share worth of 1 lakh and sell them for about 1,20,000 within a year, you get a gain of about 20,000. This 20,000 is subjected to a 15% tax, which is almost 3,000 rupees. Nextly, we will discuss about the another type of capital gains tax, which is long-term capital gains tax. So here the gains from the sale of an asset is held for a longer duration, which is about more than 36 months for real estate and more than 12 months for the securities. A tax rate of about 10% for the listed securities, which is exceeding 1 lakh, is charged. Along with this, an applicable surcharge and cess is also charged. In this case also, we'll take an example to understand this. If you buy a share worth 1 lakh and sell them for 1,50,000 after a year, then you will get a gain of about 50,000. So this 50,000 is subjected to a 10% tax, which will amount to about 5,000 rupees. As we are dealing about the ETF, we will also see about the alternate investment funds. These are funds which are privately investment vehicles that collect funds from investors to invest according to a defined investment policies. They will help the investors seeking high return and can invest in various assets such as real estate, venture capital and even more. These alternate investment fund is regulated by the SEBI, which is nothing but Security and Exchange Board of India. The SEBI Alternative Investment Fund Regulation 2012 is regulating this alternating investment fund. So regarding this article, we have tried to understand about what are exchange traded funds and what are the advantages they offer. Along with it, we have also seen about the capital gain tax and its types. We have come to the next part of today's discussion. We are going to deal with the